The air in lower Manhattan doesn't smell like money anymore. It smells like ozone and the metallic tang of a cooling server farm, the scent of a machine that never sleeps. I'm Elias. You'll hear the hum of that machine in the background of this entire story. It's the sound of your savings being digitized and deleted. I'm dressed in a sharp, charcoal gray suit that matches the slate sky outside my window. I spend my nights under the sickly green glow of terminal screens, auditing the skeletons Wall Street thought were crushed by the 2024 crash. Most are just bone meal. But tonight I found a live one. Not just a ghost, a trap that's still warm. In my hand is a leaked SEC memorandum titled Project 2026. It's a 40-page blueprint for a massacre, bound in a heavy black cardstock folder with a single blood-red wax seal. It lists 126 newly approved crypto ETFs as term-limited assets. Translated from bureaucrat to English, they were engineered to fail before their first birthday. Think of these ETFs as luxury cruise ships built with hull of sugar. On the surface, the paint is bright, the champagne is flowing, and the institutional logos give you a sense of safety. But the ship was never meant to reach the other side of the Atlantic. The metaphor is the weak listing. The SEC has projected over 100 crypto funds by 2026, but the blueprint shows that 80% of these will fail due to a lack of genuine liquidity. They are hollow vessels, packages of risk sold as diversified safety. I track the algorithmic flow. I see the ETF implosion metrics. In the simulation, the 12th month is a digital guillotine. The management fees are skimmed, the marketing hype is offloaded to retail, and then the obsolescence trigger executes. The fund delists, the ticker goes dark, and $40 billion in retail liquidity is reabsorbed by the house. I watched the ticker for ET Crypto Fund 88 on my auxiliary monitor. It was one of the 126. Within 40 seconds, the buy-side liquidity evaporated, not because of a market crash, but because the primary market maker simply unplugged the server. A $300 million fund became a zero-value tombstone while I finished my coffee. This isn't just theory, it is active execution. I recognize the digital signature on the 88 liquidation. It's the same cold, efficient code base used in the 22 depegging events. The architects didn't go to jail, they got promoted. They've spent 4 years perfecting the kill switch. Standing here, watching 300 million vanish, I realize I'm not just an observer. I'm the coroner for a crime that hasn't officially happened yet. I used to think that staying silent was just part of the professional code, that as long as the spreadsheets balanced, the morality didn't matter. But Project 2026 isn't just a market shift, it's a structural demolition. I'm speaking now because even a coroner gets tired of seeing the same staged accidents. Wall Street isn't looking for long-term growth here. They are looking for fee extraction cycles. These 126 funds are the livestock. You, the investor, are the feed. By the time the weak listing prophecy comes true in late 2026, the architects will have moved on to the next shiny product. The memorandum describes a planned cull. They approve the 100-plus funds knowing they will saturate the market. When the market can't breathe, the weak ones are choked out. It's a managed forest fire and your portfolio is the dry brush. I know what you are thinking. You think your broker wouldn't let this happen. That the regulations are a firewall. But a firewall only works if the people who built it aren't the ones carrying the matches. Let me show you the raw numbers behind the smoke. I compared the memorandum's cull list to the current 2025 Q4 filings. The symmetry is perfect. These aren't accidents, they are scheduled executions. Look at the liquidity depth on the new mid-cap crypto funds. It's a shallow pool designed to evaporate. Now let's peel back the chrome and look at the rust. Everything I've shown you, the sugar-hulled ships, the digital guillotines, it's all buried in the fine print of the SEC's 2026 projections. They know the pipeline is clogged with garbage. They've essentially built a financial hospice. Let's translate the metaphors into the cold math of your survival. The sugar hull isn't just a lack of liquidity, it's a structural flaw. Visualize a massive obsidian waterfall where the water turns into glowing gold coins as it falls. But instead of hitting a pool, the coins are being vacuumed into a hidden, pitch-black vault behind the curtain. The top 5% of funds suck the oxygen out of the other 126 until they suffocate in the dark. The statistics are grim. Real-world projections show a 75% failure rate for new thematic ETFs within their first year. In the crypto sector, that number is expected to climb due to weak listing protocols, a strategy where institutions launch dozens of micro ETFs to see what sticks, leaving the dead ones in your brokerage account. When I audit a 2026 prospectus, I'm looking for the fingerprints of a heist. I call it the red flag trio. First, check the management fees. If they are north of 1.5% for a passive crypto basket, they aren't managing your money, they are draining the battery. Second, look at the liquidity provider. If they are camping in countries where the law can't reach, your capital is already halfway to a ghost account. Finally, watch for the A-B share structure. It's the institutional fire exit that lets the big players dump their holdings before the retail lockup even hits the calendar. See all three. You aren't an investor. You are the exit strategy. The verdict is cold. Wall Street has built a high-tech slaughterhouse and painted it to look like a sanctuary. You don't survive 2026 by following the herd into the shiny new ETF gates. You survive by looking for the exits before they lock the doors. Scrutinize the backing, check the Tier 1 verification, or get comfortable in the graveyard. If you think the ETF market is a graveyard, you're only looking at the surface. Below the soil, the roots are rotting, and the soil itself is being sold out from under you. Wait until you see what the institutional lenders are doing to the bond market in our next video. It's not just a graveyard anymore. The floor has dropped out. It's an abyss, and we're all just beginning to fall.